Hello and welcome to MarketSquare, your go-to show for deep insights into business and economic trends. I'm Litre and today we are diving into key developments across Nigeria. Stay with us as we break it all down. Following the Naira devaluation, many Nigerian firms, particularly exporters and dollar earners, are bouncing back with strong profit margins, signaling resilience amid currency volatility. In June 2023, the Central Bank of Nigeria suddenly removed the Naira's long-standing currency peg. Overnight, the Naira collapsed by approximately 23%, plunging from around 416 Naira to roughly 600 Naira per dollar. By mid-June 14th or 15th, 2023, the trend continued relentlessly, with the Naira averaging now around 7 Naira per dollar by the end of December 2023 and ending 2024 about 1,535 Naira per dollar, a staggering 41% depreciation in just 1 year. This shift exposed corporate balance sheets to brutal foreign exchange translation losses across sectors, especially among borrowers and import-resilient businesses. The pain was widespread but especially pronounced in the consumer goods and ICT sectors, where companies relied heavily on imported raw materials or carried substantial foreign denominated loans. The pain was not limited to telecoms. Consumer goods producers, seven major listed consumer companies, had reported a combined pre-tax loss of 507.57 naira billion, up from 359 billion naira in 2023. Over the 2 years period, these companies collectively lost 867 billion naira, dragged down by foreign exchange exposure and ballooning interest expenses. By late 2024, the tides began to shift. The foreign exchange market started showing signs of stabilization. By Q1 2025, relative calm had returned to the naira, now trading within a more predictable band. The improved FX liquidity, coupled with stronger pricing power and cost-cutting strategies, helped many companies swing back into profitability. After nearly 2 years of losses, the consumer goods sector posted a sharp turnaround in Q1 2025. The result was dramatic. In Q1 2025, the same big seven consumer goods firms swung from a collective 418 billion naira pre-tax losses in Q1 2024 to a 289.8 billion naira combined profit foreign exchange costs, shrank into a gain of about 2.5 billion naira, while interest expenses nearly halved to 94 billion naira. These turnarounds mirrored broadening macro improvements. Consumer inflation eased for the third consecutive month in June 2025, falling to 22.22%, down from 28-year highs in late 2024. Food inflation moderated slightly and investor confidence rose as the central bank held its policy rate steadily at 27.50%, the same rate it had maintained for months to ensure inflation continued its slow descent. What began as one of the deepest corporate shocks in Nigeria's modern history transformed within 18 months into an earning revival powered by currency stability, risk mitigation, pricing power, and operational discipline. Dashboard full of losses and declining shareholder value gave way by June 2025 to bold earnings numbers, rebounding dividends, rising market caps, and fresh narrative of business resilience. The pain from devaluation turned definitely into profits. But while companies are seeing gains, consumers continue to feel the pinch. Petrol prices are edging close to 900 naira per litre, driven by international oil market dynamics, and OPEC Plus plans to adjust output levels. The pump price of petrol may hit 900 naira per litre this week if the price of crude oil continues to over around $70 per barrel. This was even as OPEC Plus, a group that comprises non-members of the Organization of Petroleum Exporting Countries, agreed to raise oil production by 547,000 barrels per day for September. Petrol marketers across Lagos and Ogun quietly raised depot prices from 987 naira to 900 naira per litre, while filling stations tagged retail prices between 900 naira and 910. As skilled lending, the luminous spectre of 900 naira per litre at the pump prices become more just than a headline. It become household reality. Behind the price surge lay the latest OPEC Plus strategy. On August 3rd, 2025, the alliance, specifically the voluntary eighth bloc, including Saudi Arabia, Russia, UAE, Iraq, and others, agreed to boost supply by 547,000 barrels per day beginning next month, fully unwinding a 2.2 million barrels per day in parallel voluntary cuts. Despite what should have been bearish news, crude prices barely budged. Brent remained anchored nearly $60 to $70 per barrel, reflecting market doubts over whether key players could deliver on their output pledges. For Nigeria, where nearly all refined products is imported, that resilience in global crude oil has translated into relentless landing cost hikes. The major oil marketer association reported the 88 naira surge in 1 week alone, and as depot prices reached 885 naira compared to 816 naira delivered from Dangote's refinery. By now, many Nigerians recognize the arithmetic. 900 naira per litre eats into wages, stokes high transport fares, and ripples through food prices. Inflation already in the 30 to 35 range is on pace to rise by an additional 1 to 1.5 percentage points in the next few weeks. Labor unions and human rights groups are renewing demands for wage indexation and subsidies. Threats of strikes now loom louder than what they did at the 820 naira per litre crisis of summer 2024. At the federal level, the reforms introduced by President Bola Ahmed Tinubu, full removal of fuel subsidy combined with the official naira float, have unlocked fiscal breathing space. In just over 2 months, the government saved over 1 trillion naira, with annual savings estimated at 4 to 8 trillion naira funds that have been redirected to federation accounts, capital infrastructure, and social programs. Despite these gains, the IMF has urged Nigerians to recalibrate its 2025 budget, warning that crude prices averaging $68 to $69 are below the 75 barrel absorption, while oil output continues to lag the 2.1 million barrel per day target, leaving a 13 trillion naira deficit forecast undelivered. Still, alternatives are emerging. The CNG conversion push, launched alongside subsidy reform, now covers over 100,000 vehicles through infrastructure shortfalls and low public buy-in limit uptake. Switching to gas could halve transport costs, but Lagos-Abuja schedule remain Mure-like. Full deployment is projected only by 2028. Meanwhile, Dangote, the country's petroleum supply anchor, is under pressure to resume narrow settled resale contracts, a move analysts believe could help stabilize wholesale pricing. Meanwhile, Dangote, the country's petroleum supply anchor, is under pressure to resume narrow settled resale contracts, a move analysts believe could help stabilize wholesale pricing. Even as OPEC Plus floods the market to extra barrels, the reality for Nigeria is sobering. Unless forex risks are tamed and downstream competition rises, the 900 naira per litre mark may well become the new norm, not a protest peak. With demand growth forecast at 800,000 barrels per day annually and cheap Russian oil on the sidelines, Goldman project Brent could dip to $64 barrel by Q4 2025 and $56 in 2026, but stresses the headline forecast depends on delivery and geopolitical stability. OPEC Plus is adding supply, but Nigeria is still locked in a dynamic of expensive imports, naira fragility, and unpredictable pump routes. Despite the court pressures, the Center for Promotion of Private Enterprise remained optimistic. The group forecast Nigeria's GDP could reach $450 billion by December, reflecting a rebound in business activity and investor sentiment. The Center for the Promotion of Private Enterprise wants special attention to be given to sectors of the economy that were contracting or in recession, as it projected a $450 billion economy by year-end. This call was made in a CPPE's statement on Nigeria's GDP rebasing Q1 2025. And sectoral analysis signed by the Managing Director, Chief Executive Officer, Dr. Muda Yusuf. In July 2025, the National Bureau of Statistics rebased Nigeria's GDP from a 2010 to 2019 base year, causing headline GDP to jump by 41 to 42%. The economy was reestimated at 378.82 trillion naira in 2024, roughly $244 billion at current exchange rates. This rebasing added sectors such as e-commerce, startups, pension administrator, modular refineries, and parts of the informal economy that were previously undercounted, reshaping not just the size but the structure of the Nigerian economy. By the end of Q1 2025, real GDP had grown 3.13% year-on-year, up from 2.27% a year earlier. Output in a quarter reached 94.05 trillion naira, nominally up from 18% over Q1 2024. Cumulative that puts Nigerians' year-to-date GDP at 466 trillion naira, or around $300 billion. Crucially, the service sector led growth, expanding 4.33% and accounting for 57 to 58% of GDP, while agriculture and manufacturing expanded at a measure of 0.0% and 1.7% respectively, highlighting a loop-side recovery. Against that backdrop, CPPE, led by Dr. Muda Yusuf, issued a statement on August 4, 2025, saying if the economy continues recovering without major disruption, Nigeria's nominal GDP may reach $450 billion by year-end. That implies nearly $150 billion in nominal growth across just 3 quarters, essentially a 50% surge on a Q1 base. But what would this require in practice? For nominal GDP to leap from $300 billion to $450 billion, Nigeria will need to either sustain inflation in the high of 20s or low 30s, or real growth accelerating sharply above 5%, or both. Inflation remains elevated. It climbed to 34.8% in December 2024, before falling into mid-20s following a CPI rebasing by March 2025. Inflation had eased to around 24% 4.2% to 24.3%, with agriculture and manufacturing growing at 0.7% and 1.7%. CPPE had repeatedly warned that productivity in these critical sectors requires targeted intervention if growth is to be inclusive and sustainable. These are significant risks. The federal budget remains built on optimistic oil prices and production assumptions, projected at $75 and 2.06 million barrels per day, even as global prices and outputs are thus further falling short. Debt services is already crowding over capital spending. The country's fiscal deficit remains in the 3 to 4% range, and the debt to GDP ratio hovers at around 40% figures, greatly influenced by the inflated GDP. If Nigeria manages to sustain inflation in the mid-20s or low 30s, maintain non-oil sector growth of 3 to 4%, and avoid micro shocks, closing the gap around $420 to $430 billion in nominal GDP is possible. But reaching the full $450 billion will require a near-perfect convergence of inflation, structural reform, and sectoral real growth, all aligned and all maintained. The $450 billion remains aspirational but not transformational. It reflects a nominal milestone and not a shift in ordinary Nigerians' living standards. Inflation still eats into purchasing power, real growth remains subdued, and revenue collection is not keeping pace with headline GDP. It is essential to recognize headline GDP can grow even as real incomes and household welfare stagnate. The Nigerian Exchange Group equity market sustained a bullish trend for the 10th consecutive week, crossing an all-time high of 141,000 points, driven by increased activity in industrial goods, banking, and consumer goods sector. The all-share index rose 5.07% to close at 141,263.05 points on Friday, up from 134,452.93 points as of August 4, 2025. The market capitalization was at 889.37 trillion naira, while the year-to-date return closed at 37.25%. The sectoral index performed bullish last week, with the Nigerian Exchange Group Industrial Goods Index climbing 10.12%. The Nigerian Exchange Group Banking Index increased by 3.49%, and the Nigerian Exchange Group Consumer Goods Index rising 2.72%. The Nigerian Exchange Oil and Gas Index fell 0.48%, and the Nigerian Exchange Insurance Index declined by 1.22%. As a result, analysts advise investors to stay alert and align their portfolios with current recommendations to strike a healthy balance between growth potential and risk management in this volatile market environment. That's it for today on MarketSquare. Thank you for joining me. See you on the next one.